morning, Amyr.
Good morning, Simon. How are you?
I'm very well, thank you. Very well indeed. It's nice to be going back to the office now and again rather than just working from home every day.
Absolutely, and getting to see clients in person again is brilliant. So look, I'm looking forward to our chat today.
Absolutely, yeah.
We're going to be talking about some of the different ways to think about investments and investment management. Because often when we see potential clients for the first time, folks that have been referred to us very kindly by our existing clients, we notice that there's a slightly different target that people are trying to achieve when it comes to why they invest and how they're investing versus what we do, which is maybe not as intuitive as one might think on their own. So I thought it would be interesting for us to just have a chat as if we would have at the water cooler in the over in the office, and folks can just get a feel for how we think about investing and the things that we think are important to be mindful of when constructing an asset allocation, running an investment portfolio. And maybe to people's surprise, Simon, I'm going to just share a few slides if that's okay. I think it makes it easier. I'm going to start by talking about something that I think we both think is really important, which is inflation.
Hugely important. In fact, we talk to clients about risk, and actually what we're often talking about is volatility. That's what we mean, or a lot of clients immediately assume. But actually the most insidious form of risk is inflation. And it creeps up now. It wanes and it flows, but actually maintaining your buying power or parity and actually investing for a reason, which is to not only maintain, but to ideally to increase the value of your money so that you can maintain, at least as a minimum, the same amount of goods. And in this case, we're using the example of milk.
That's it. We're keeping it really simple, and we will let the client or the potential client or the audience that's listening to us now extrapolate this in their own mind. But just imagine milk, the most basic and simplest of products that we probably all have in our fridge. So we're using here the example that in 1919, you could buy the equivalent of 4 pints of milk for about 7p. Now, Simon, I know you did some research on this and you went onto the Waitrose website. So furnish us with your research on the price of milk.
It's worth pointing out that other supermarkets are available. That just happens to be the one I went to here. But if you buy 4 pints now, which of course is now sold as 2.27 litres, the economy range comes in at about £1.20, and if you're going for the organic, it's more like £1.85. Now,
and that's for each pint.
No, that's for the bottle. That is for the jug. But what we're equating to here is 4 pints or 2.25 litres, and for 7p back in 1919, and you get about 80 ml, and that's a factor of, off the top of my head, about 25. And equally, if you take 7p and factorise that by about 25, you get to about £1.50, and that's there or thereabouts. So if you had 7p in 1919, you would have had to invest in it, and that had to have been £1.50 now. So it has to increase by that same factor of about 25 just to maintain the same goods.
Absolutely. And why is this important? Because as a firm that specializes in retirement planning, the stats, the empirical evidence out there tells us that a couple who have got average life expectancy and are retiring around age 60 can probably expect to see the second death happen after a 30-year period. In other words, once you've built the nest egg up until the point where you then want to retire and get that nest egg to fund the lifestyle you want to have in retirement, you need to be mindful of the fact that that money needs to work for you for pretty much as long as it took you to build that pot in the first place. And what's working against you, forget everything else for a second, but the fundamental thing that's working against you is that the cost of your lifestyle is slowly but surely becoming a little bit more expensive every year. Now, we've used the example of milk here, but as I said, folks watching us now can start thinking about the cost of their lifestyle, of the things they want to do and buy, and how that would weigh on their income requirements over such a long period of time.
Indeed, it's particularly relevant at the moment, and it is a concern that clients are starting to voice, because over recent years, over recent decades, in fact, inflation has been at an all-time low. And in fact, if we look at the average over the last 20, 30 years, it's been about 3% per year. Now, 3% nevertheless eats away at the value of your capital. Right now, in 2021, clients are starting to say, well, have you seen the inflation, let's say on building products? Have you seen the inflation required to fund an HGV lorry driver? And this will be a driver. And actually, for my own curiosity, because I'm old enough to, believe it or not, just about remember the inflation for the 1970s, although whilst I was at school in those days and at university, I can't say it particularly affected me. So I went back just out of my own curiosity, just to have a look. And during the 1970s, inflation averaged 11.5%. If you look at one particular year, that was 1974, inflation, as measured by RPI, was 26.8%.
Yeah, that's phenomenal.
Now, which is staggering. A lot of our clients are old enough, those who are retired, to remember that, and that is now their concern. So they're really saying, are our portfolios adequately geared to maintain parity or investment buying power in a way that will be possibly required over the next few years?
100%. You know, this is where we then start thinking about how to build the asset allocation and how to run these investment portfolios to ensure that the income derived from those portfolios can indeed not only keep up, but also beat inflation over time. And the way we fundamentally start thinking about this is by way of this cartogram, or this cartograph, sorry, my apologies, this cartogram that I'm showing to clients now, to folks now. And what this is showing people is the balance of equity or stock market investment opportunities around the world. And I'll just say that again in a second. This map is showing, you recognize the names of the countries in this map, I'm sure, but you're probably not recognizing the proportion of their sizes in relation to each other versus a normal map. Because what we're showing you here is effectively the total value of shares that are issued publicly by publicly traded companies in those markets, and the value of those given the size of that particular country's stock market. And therefore, the jargon for that is market cap for that particular country. Yeah. Now, when you start viewing the world as where are these stock markets more active and have more publicly listed companies that are selling the goods and services that we're all buying, suddenly you start thinking about diversification and about where potentially, to which markets potentially you would allocate your investment money. You start thinking about that in a slightly different way.
Well, you do indeed, because as we know, and this is a global phenomena, most people invest with a heavy bias towards their own economy. And that's true of investors in the US. It's also true of investors in Australia. Now, if diversification is the name of the game, and it is, then the logic of investing substantial amounts of money in Australia versus the US are complete opposites. And actually what we're trying to say here is the UK, whilst we used to rule the waves, in terms of market cap, we are a relatively small nation these days. And so actually, if we look at the globe as our potential marketplace, that's how we should be investing.
Absolutely. Now, unfortunately, that is not what you and I see and hear when we typically meet a prospective client for the first time. In fact, I'll say that what we typically hear can be boiled down to about 4 fundamental ways that folks out there on their own, being influenced by all the noise that is around them, are thinking about. And the first one of those, the most common approach, is based on this idea of prediction and forecasting. Now, methods around this probably include picking stocks that are, for some reason, expected to perform well in the future, or moving out of an industry sector because of a particular bit of news, or in general, just attempting to time the stock markets. Now, unfortunately, the truth is, and it's empirically proven, it doesn't work, does it, Simon?
It doesn't. And what's interesting is that we know that folks try and time the market, and they try and time the market based upon a number of factors. And a lot of it is based upon expectation and belief. And sometimes it's based upon fear. And as we were talking just about inflation, I had two stats. One was inflation during the 1970s, and I also had stock market performance during the 1970s. Well, if you looked at the performance in 1973 and 1974, and you'd seen the losses that you would have made, then I think a lot of people would have sold. And then they would have missed out on what happened in 1975, which was a massive recovery. So people base predictions on, well, a whole bunch of sources, don't they? Are sort of market pundits, journalists, friends down at the pub. But I think we've got another sort of slide that leads on to that. Is that correct?
Absolutely right. And that's where we see this other approach to investing, which I think goes one step above predicting and trying to forecast things, which is this business of acting on an impulse, acting from an emotional perspective. Now, we appreciate that the amount of information that is out there today and the access to information that we have here in the UK through online magazines, through 24-hour news and everything else, it might seem like you're consuming relevant information for most of the time. Unfortunately, again, that isn't the case. What that information that is being pumped out is doing is making people react either from, at least when it comes to investing, financial planning, and the financial markets, it's making them act or think or spark an interest in things from either a perspective of fear or from a perspective of greed. And that's where the forecasting and the predicting really then starts becoming impulsive, and people just want to try to get on a particular wave or a particular story. And the acronym, I think, is FOMO. It's, fear of missing out.
Absolutely.
Missing out on what you and I, Simon, ask people. What do they think they're missing out of? Because we know that outperformance, whatever that means, on its own is not a financial goal. A financial goal is a retirement income that you can live on and that can at least keep up with inflation over a potentially 30-year time span. A financial goal is being able to help fund a grandchildren's education or leave a legacy behind to the people you care about or to the charitable causes that you care about. Those are financial goals. That's what you build a financial plan towards. Those are the things that make investing something relevant to pursue and worthy of pursuing. If one is building one's nest egg and then has this fear of missing out on the next big thing, my first question to them would be, why? What is the driver of that fear or that feeling of greed, of wanting that outperformance, again, whatever that might mean? Because it probably isn't based on some of those real financial goals, some of those things that real people are really urging to achieve in their life.
Yeah.
And by the way, if you're listening to this and you can recognize some of these behaviors, you're not alone. You're not alone. This is part and parcel of how we're built as a species. And now we're dealing with the financial markets, but still with that DNA of the folks that were running away from tigers and dangers that were rustling around in the bushes.
Do you know what this slide reminds me of? Do you remember the cartoon of the curve, and it shows the market's increasing, and it's showing that people have this FOMO, and once the markets have risen for a considerable period of time, they want to buy in, they want a piece of the action, they want to see some of that growth. And when it drops, they get scared because they've committed too much money or they've taken too much market risk. And the cartoon is very sarcastic, simply says, buy high, sell low, repeat until broke.
Absolutely.
And this summarizes it for me.
It does. And the interesting thing about this is when we start to think about this from the point of view of investing versus speculation, which is what you're talking about there, Simon, because when you're investing towards a worthy financial goal that is at some point down the line in the future, I feel, and we feel this with our clients, that one is more tolerant of the volatility that one might experience along the way. Because you can see that you're still progressively getting closer to achieve that goal when you have a financial plan to base that on.
It is. It's built into the plan. It is built in to expect market volatility. It's built in so that we have a buffer of cash so that we don't need to encash at the wrong time. And we also have an understanding as to how much volatility we would expect along the way. So it is part of the plan. As long as you're staying on track on the plan, there's nothing to worry about.
Absolutely. Whereas the flip side of that is when we meet people who perhaps because they just didn't know any better, they've never worked with a financial planning firm like ours, they haven't really properly put a retirement plan in place for their own future. When they act from this place of fear or greed, and they're really speculating with their savings that they're allocating towards their retirement fund or their ISAs or what have you, we see a lot of anxiety about investments come with that package. And a great example of that is what happened in March, April of 2020, where that anxiety, that fear of seeing what was happening in the global stock markets due to this global health pandemic, which none of us have ever experienced anything like it, it has meant that a lot of people decided, this is too much, I'm out. And they've pulled out of the market, crystallizing that temporary loss, crystallizing that temporary decline. And what we've seen is a lot of these people, unfortunately, we're starting to meet them now, have stayed in cash. Because, you know, the problem with market timing is that not only do you need to get it right, as in the time that you sell, but you need to be right again, because you need to find the right time to buy again. And that fear has meant that a lot of people have missed out on the incredible recovery and beyond that the global stock markets have experienced, given that these publicly traded companies, these firms that you and I and everybody listening are buying goods and services from on a daily basis, have been able to reignite, recover as the world starts opening up again. And to do so, apologies, Simon, but and to do so in a way that's potentially leaner, restructured, more profitable, and optimized for the world we're living in now.
And this is repeated time and time again. You know, I remember very clearly the banking crisis where people were particularly concerned. And we did explain to them how this has happened time and time again. And the comment I heard a great deal was, yes, but it's different this time. Well, it was a different flavor, but it was exactly the same. So we had pretty substantial losses in 2007 and 2008. And that was the point in time where people had sold, they'd moved out of equities. 2009 was a cracking year. I'll also add, if I may, just because I have the stats in front of me that I brought up when we were looking at inflation back in the 1970s. The stock market lost in 1973. This is the FTSE All Share, so this is the index of all UK publicly quoted companies, 55%.
Wow.
If you look at the 2-year negative return, 1972 and 1973, annualized, it was 42% a year. Now, that's a 42% loss followed by a 42% loss. We quickly forget that, and so the market would have been down a substantial amount in the region of 70%. However, 1975, 151% positive return. So exactly the same again. It just happened to be 2 years of pretty hefty losses and then a fantastic recovery. And a substantial number of people will have missed out on that simply because of fear, being wrongly geared, not having a plan, taking too much risk.
Definitely. And, you know, I think that leads us nicely to the last point that we're going to be making in this particular fireside chat, which is just be wary of not being swayed by the financial media or the popular media. And I don't mean that as somebody that doesn't consume news myself and doesn't value the service that good journalists provide to the various different types of news and sectors of news that inform us as human beings. That's not it at all. But it is true that even when we look at some headlines, as the audience can see here, are pretty old, and then they compare and contrast with the headlines today, they will notice that a lot of the headlines in the popular media and the financial media are out there to try to define what investing means to people. And this, given what Simon and I have just gone through in this conversation, these headlines are not what investing is. This is what a financial or a popular media publication will put out on their website or on their TV program to try to target your human emotion, to try to make you either feel greedy or feel fear and make decisions on impulse based on those emotions. So just consider these messages when you're reading the news, and consider maybe where they're coming from and if they are indeed sparking those emotions in you.
Journalists need to write articles once a week or once a day, and financial journalists can't write the same thing every day, and therefore they tend to make predictions. What they also tend to do is to forget the ones very quickly that were wrong. The previous slide talked about, your friend at the pub or your friend. There's another classic case of what we would call survivorship bias, which is your friend at the pub will tell you the fund he bought, which absolutely shot the ceiling out, it did so well. He won't tell you the one that he bought that fell through the floor. And we're not trying to shoot the lights out, and we're certainly trying to avoid this roller coaster ride. So actually what we're interested, as far as the client is concerned, is benchmarking the performance against your financial plan. And actually in so doing, what we're looking for is a long-term consistent return net of all fees.
Absolutely.
That matches your plan and gets you to the end of your days.
Absolutely right.
That's it.
Absolutely right. And that's what we're looking to try to deliver when it comes to retirement plan, right, Simon? It's that financial plan that, backed by a sound investment portfolio, will deliver to the client what they consider to be a fulfilling life. And I want to stress that point. It's what they consider to be a fulfilling life.
Absolutely.
And if that means some part-time work or voluntary activities during retirement, fantastic. If that actually means taking a step back and just looking after the grandkids and, maybe being of service to their own community or to a particular group in their community, that's great too. It's whatever it means to them.
Everyone needs fulfillment in life, and it's individual to everybody.
Yeah, absolutely. Well, look, Simon, I appreciate the time you took as well to do that quick study and bring us up to date to where we are with inflation and returns. I hope it's been helpful for people to see that there is a different way to think about investing, and that those common ways that one is almost taught by default to think about the world and the investment opportunities that are out there, maybe, just maybe, they're not always in your interest. So it's worth being mindful of them.
It is. Thank you very much, Amyr. I look forward to speaking to you again soon.
Thanks, Simon.
Goodbye.